You getting what?
A stock.
What stock?
Did you ever meet my friend Simons?
Maybe.
He knows this guy Wilkinson. He made a fortune in the stock market. Now he's got some new thing. But Simon said that if I wanted to get involved, that Wilkinson would tell me the exact right minute to sell. Do you want to do it?
Boy, I don't know.
I'd do it, but I don't have any money.
What kind of company is it?
The true bearish thesis behind why Alibaba stock is the biggest loser of 2023 on Wall Street. Honestly embarrassing. Baba stock is a laughing stock. Ha 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 ha.
Well, how much are you going to invest?
5,000. 10,000. 5,000.
Introducing Teddy. As fellow existing Baba shareholders, we get humiliated. Laughed at because it seems like every single China news is Alibaba's fault. It's always good to reflect back and to critically evaluate on whether there's still a very compelling argument on why Alibaba is a good investment or not. And I want you to join me in this exercise together to really consider whether you are able to address them personally.
Boy.
Come on. Wilkinson's got millions invested in this stock. It's gone up 3 points since I've been watching it.
What if I lose it?
Come on. Go for 2,500. We'll do it together. Come on. Come on. We're in it together.
All right, 2,500.
That's it.
And think about how to look at this entire Alibaba investment thesis today. Alibaba shares are still down 77% from 2020. While S&P 500 is close to an all-time high, Baba is ridiculously cheap. Since 2015, its earnings have more than tripled, while the share price has been flat. It is trading at 9 times trailing PE. Even more importantly, the company sits on a $63 billion net cash position and a diverse portfolio of equity investments, around $34 billion, and a stake in private companies, which is roughly $29 billion. So taken together, net cash and investments has a value of around $125 billion compared to the market cap of $197 billion. So put differently, 64% of the company's market value is in cash and investment. Pretty good, right?
I don't like to discuss figures.
How much?
I don't know, what, 8,000. It's a Hyundai. Get out. I told you not to sell.
The other 36% is the implied value of the core business. So how can such a well-known liquid stock be so completely overlooked by the market while the rest of the market goes parabolic? The e-commerce market share reached 30% of Chinese retail, above the US and Europe. Alibaba could face more issues expanding in other segments due to a more stringent regulatory regime in China. Its international operations are probably the only segment capable of gaining shares, so I think I do largely agree in terms of the penetration due to the proliferation advancement of tech in China. Basically, everyone has access to a smartphone and everyone is a customer of Alibaba. If you look at the ecosystem of annual active users, they have 1.3 billion active users. That's literally the entirety of the Chinese population. But I think now the focus really is not in terms of penetration, but more so trying to bring more and more people up the value chain and to consume more. And I think the entire argument of Chinese retail being oversaturated is wrong. That's not the case if you look at one of the biggest rival of Alibaba today. PDD it has experienced a momentous rally. It's up 73% year to date. So you can't really say e-commerce is really the issue. And more importantly, if we were to superimpose what's happening to the Chinese economy by and large today, I do believe that e-commerce is quite cyclical in nature. And of course, let's not forget that Pinduoduo is expanding aggressively in the international market, which is why they are posing great record growth. That's also one of the potential reasons why Baba is losing. Next, Chinese economy. So there are deeper issues with China's economy than previously thought, including hidden leverage, population decline, export restrictions, even with great amount of leverage, population decline, and even a deflationary problem in Japan. The Japanese stock market seems to be coming back.
Jerry, the stock is the same as when you checked it earlier. There are no changes after the market closes. The stock is still down.
I know, but this is a different paper.
For geopolitics, US, China, and Taiwan, so this is obvious, and personally, I don't think it's very self-explanatory. For those of you who do hold BABA, I would like to have a deeper engagement and discussion around this point. What do you think, Ted? Ted says this is serious. A serious discussion, Ted? It's serious, he says. So let's first talk about Taiwan. So a lot of the discussion around Taiwan today is that, oh, there's an impending invasion. If they invade into Taiwan, a lot of the funds will be pulling out of China. That's not good, Ted says. That is not good at all, right? Oh, Ted is not happy about that. That will actually make China very unhappy. Oh, it'll make you unhappy too, Ted? Oh, it's going to make him unhappy too. This is what Ted thinks. Oh. And that's why China is uninvestable. But let's take a look. Is that really the case? So Taiwan, which is the issue at hand? You can see that the Taiwan stock market index is basically just climbing up. It is approaching its all-time highs, betting that the Taiwan is not going to be invaded. And you're telling me that the capital market investors are scared of the Taiwan invasion. Really? This is something I don't understand. If they're not even scared of the Taiwanese stock market, why does it have an impact on the Chinese stock market? On the second part, when we talk about US-China relations, I do believe some investors are worried that, oh, the US government might mandate certain funds to restrict the fund flow to China. And that causes some sort of depression in terms of the stock price and valuations. And I completely agree. But when I go back to the perspective of an investor assuming that the company's earnings is not a value trap and they can continuously grow their earnings, their margins, cash flow, and revenues, they are going to take care of shareholders, whether it is via buybacks or whether it is via dividends. To me, I still think that there's one most important thing that drives returns, which is earnings. In the long run, it's the company's earnings and whether they take care of their shareholders. On some of the parts, the valuation appears to be no longer relevant, so even if canceling the IPO of Cloud, it is just a one-off.
Get down!
Sorry, boss, I can only use it once. It's a one-off.
Now I think strong competition is a much more important point. Not only did Alibaba lose some market share in the past 2 years, mostly to Pinduoduo and Douyin, but it also had to reduce its commission for merchants and offer other incentive to remain competitive. So the company had to increase investments to adjust its business model. All of this affected sales and profit margins. I think I largely agree. The writing is on the wall. If you are in agreement with the common narrative around China today, where there is a lot of leveraging, consumer sentiments are hitting rock bottom, savings are at all-time high, and people are now willing to spend, then you will probably expect this kind of declining financial metrics. You can't tell me that on one hand you do believe that China is in a very tough place, but on the other hand you expect many of these companies to continue posing record margins, record growth. For me, the story I tell myself is that yes, China is not in the best position right now. If you see this as a short-term headwind, the share structure has been an argument since first day of listing, but it has become more relevant now, so neither holders of shares of ADS own the underlying Chinese operation. This, I disagree about it. Now I'm using the look at PDD example again. The year-to-date PDD is up 73%, but if you take a look at the disclosure of PDD, and surprise, surprise, Pinduoduo is also governed by the same share structure as Baba. I think my biggest issue, especially for investors that keep bringing up this idea of geopolitical concern, so I think I too enrich this discussion on two fronts. Are you concerned about the geopolitical risk in a practical implication or on a financial implication? On the practical implication, mean if the US and China tension continues to escalate, they starting sanctions on each other, and many of these companies in the middle will be caught. So if you're really concerned about the practical implication, then you better be applying this sort of discount rate for companies that also have businesses and supply chains in China, as well, from Apple to Tesla to Nvidia to even Starbucks to Nike. If you're not, then you're telling yourself two different stories. The practical consideration of this geopolitical race is really not up your agenda. You're just using it as an excuse.
Bad news, my friend.
What news?
Zentrax.
Oh, come on, it's down again.
2.5 points.
That's 4.5 points in 3 days. That's almost half my money.
Hey, I told you.
The financial implication, so some investors on the other hand might be in state concern about this financial fallout between US, China, and maybe the US government just banning their own citizens from owning Chinese exposure or Chinese equities. But we are already seeing it in real time, where many of these US mutual funds, hedge funds, are pulling out of China. But let's also not forget the other side of the coin, which is investing into China today. It's not sexy. In fact, you'll be the laughing stock. People hear that you have Chinese equities, they'll probably laugh at you. And because the demand is waning, that's why many of these large fund managers like BlackRock, Vanguard, they are all closing their funds, and not really because the government's telling you, oh, you can't invest in this company or can't invest in this country, etc. On the flip side, if you're more worried about the Chinese government declaring all of your investments to be illegal, I think there are many other levers that the Chinese government can pull on the US government or retail fund flow. Jack Ma's funds announced a plan to sell $10 million ADS, but they have since walked back on their claim because they believe that the current stock price is far below its fair value. Regarding to large cash balance, based on the last 2 years, many of business execs are expecting tough times ahead, so you probably want to be more prudent in terms of how you manage your cash position. Regarding cloud management, spoke about the growth potential of cloud and tech. However, at the same time referred to the U.S. restrictions as hindering future growth, so management has not provided the details on how the restrictions could affect its cloud business and what it is planning to do about it. But I think patience is running very thin amongst many investors today. What do you think, Ted? Oh, Ted says yes. Yep. We're running out of patience now.
I don't care. I'm just telling you to get rid of that stock now.
George, what's going on?
Sell it. Just say, I'm selling.
Well, where is the guy? Nothing. Almost half my money's gone.
Why Alibaba share price continues to stay submerged, how the different players in the financial business is purposely keeping Alibaba's share price down. This Japanese fallen angel, SoftBank, will obviously benefit out of Alibaba's price going down. It is even written black and white in their financial report. SoftBank was one of the largest shareholder in Alibaba, owning more than $100 billion of BABA. Last year, we had a banking crisis because of rapid rising rates. SoftBank is in big trouble, so SoftBank has moved to sell almost all of its remaining shareholding in Alibaba, limiting its exposure to China and raising cash. The Japanese group has sold out $7.2 billion worth of Alibaba shares this year, though prepaid forward contracts after a record $29 billion sell down last year. So the forward sales revealed it will eventually cut SoftBank's stake in Alibaba Group to just 3.8%. And the Japanese investor once owned as much as 34% of Alibaba. In a scramble to survive, SoftBank is killing Alibaba. So BABA closed the session crashing 9% after the results beating expectations across the board, leaving many dumbfounded.
Well, this is it. I'm selling.
Just give it a little more time.
I never should have gotten involved with this. I'm a nervous wreck. I'm not cut out for investing.
On August 10, 2022, SoftBank announced the physical settlement of the prepaid forward contracts related to Alibaba shares. At that time, SoftBank owned 23.7% of Alibaba. When all these derivative contracts expire, they'll be left with only 3.8% of BABA shares. So what is a prepaid forward contract? So in this derivative, the buyer of the shares, which is the brokers in this case, pays an advance to the seller. SoftBank, the present value of the future sales price, agreed upon. So thanks to this trade, SoftBank immediately booked gains for the quarter, since they were marking to market their BABA holdings at around $91 at that time. Furthermore, banks paid them a badly needed $1 billion in cash. So this is the true thesis behind why BABA stock was pushed down ultimately, because the fallen SoftBank is selling it by hundreds of $1 billion to save its butt. The more traditional value group would point out that genuine bargains are found in situations where everyone is pessimistic. It is uncomfortable to own a particular stock, and it is embarrassing to talk about it at a cocktail party.
I know, it's down again.
How much you down altogether?
I don't know, $1,500?
Wow.
Having an edge is almost impossible in a liquid and well-covered stock like Alibaba, but emotional edge pays off when a company's product remains strong and its management team continues to have faith in the company. In conclusion, Alibaba's price fantastically attractive, especially considering its cash and investment. However, this is a widely known stock, and there are reasons why the market may be discounting the stock. So emotional edge works in situations when a company's underlying business remains in good shape. In the case of Alibaba, there are signs that strong competition and adverse regulation have eroded its competitive advantage.
Didn't work, huh?
Not quite.
Well, what are you going to do about this stock?
I'm keeping it. I'm going down with the ship.
But I am not selling. I am going down with the ship. We're not selling. No, we're not. Nope, we're not selling. This bear is bullish. You're bullish, Ted? Yes. Bullish.
It's up 6 points.
Told you not to sell.